Okay, you guys, we're now going to look at long-term assets. Now, those would be assets that benefit more than just the current period. Um, would be the kind of the opposite of a current asset. A current asset, of course, was cash and any other asset that we expect to consume or convert back to cash within 1 year. Well, the long-term asset would be an asset that helps the business to generate revenue um, over an extended period of time. So, more than a year at least. A lot of times 5 or 10 years, could be up even 40 years for some assets. Now we're going to look at a few types. Property, plant, and equipment is the most common type of long-term asset, but we're also going to look at some intangible long-term assets as well. So we'll start here. I'll give you their definition, or we'll look at a definition here. Long-term assets are assets that allow the company to generate revenue for multiple accounting periods. They fall into two major categories. Okay, we've got tangible assets and intangible assets. Tangible assets are assets that have physical substance, such as land improvements like driveways or fences, buildings, equipment, and natural resources. Natural resources could be like an oil well or a coal mine. Intangible assets are assets that lack physical substance. It really just represents some type of legal right, such as a patent, a trademark, copyrights, franchises, and one we'll talk about a little later called goodwill. It comes onto the books when one company purchases another company, or it can in that situation. All right, when purchasing assets, a company will capitalize the cost. That just means the company will record the asset at the asset's cost plus all required expenditures to get the asset ready for its intended use. If you buy a piece of equipment, it would not just be the equipment cost, but also the cost to set up the equipment and get it ready to perform the function that you purchased it to perform. Then that cost that has been capitalized, we're going to expense it over time, meaning we're going to take a portion of its cost each year that we use it as an expense, right? Because it's in line with the matching principle, right? If it's helping us generate revenue over a 5-year period, then we want to take part of its cost as an expense in each of those 5 years. Okay, this allows a company to follow the expense recognition principle. Now, I just called it the matching principle, but two names for the same thing. Since the asset generates revenue for multiple accounting periods, the expense of purchasing the asset should be spread across all periods that it helps us to generate revenue. All right, now the life cycle of a long-term tangible asset. Now we typically call that property, plant, and equipment on the balance sheet. It's got 3 stages there. We've got acquisition, when the asset is acquired by the company. You could think of that as the day they purchased it. Depreciation, the company uses the asset to generate revenues in the company and allocates the cost of the asset to the proper accounting period. We do that through depreciating the asset, and we'll look at some methods of doing that shortly. Disposal, that's when the asset is no longer beneficial to the company, so it must be disposed of. Now, it could just be junked, or it could be sold. Few ways it could be disposed of, but scrapped or sold. Stage 1, acquisition. Let's begin with acquisition of property, plant, and equipment. Okay, when acquiring the asset, a company must include all costs to get the asset ready for its intended use. We mentioned that earlier, but now let's take a look at an example there. So let's say a company buys some land. That's the one we're going to look at first here. On March 1st, 2024, Mark Company acquired real estate on which it planned to construct a small office building. The company paid $75,000 in cash. An old warehouse on the property was razed or demolished at a cost of $6,400. All right, now, you guys, that would be included as part of the cost of the land. Let's look at why did they buy it? To construct a small office building. Well, the old warehouse would have to be torn down before we could construct the small office building. So to get the land in the condition we need it in for its intended purpose that the business bought it for, that warehouse would have to be demolished or razed. The salvaged materials from the demolition were sold for $1,200. Now that would decrease the cost assigned to the land. We got some cash back there from those scrap materials. Additional expenditures before construction began included $800 in attorney's fees for work concerning the land purchase. We could include that as part of the cost of the land. A $3,800 real estate broker's fee. We could also include that as part of the cost of the land. Now the architect fee, that's going to be a part of the cost of the small building. And then $11,000 to put in driveways and a parking lot. That's going to be considered a land improvement that we mentioned earlier up here. Driveways, fences, things like that are considered land improvements. So let's look at it a little further. They want us to determine the amount to be reported as the cost of the land. Well, I kind of mentioned it as we went through, but the land cost would include the purchase price of $75,000 plus the $6,400 to demolish the old warehouse and razing. Razing and demolishing, just two words for the same thing. We'd subtract the salvage or scrapped materials that we sold. That actually decreases the cost, right? Some cash we got back. And then the attorney fees of $800 would be included as part of the cost of the land, along with the real estate broker fee. So we come to what? $84,800 as the cost of the land here. So what did we not include? Well, the architect fee of $5,800. That's going to be part of the cost of the building. Building would be debited for the $5,800 architect fee plus the other cost to construct the building. And then land improvements, a separate asset, would be debited for the $11,000 driveway and parking lot cost. Now, besides the items mentioned here, if the purchasing company, in this case Mark Company, had to pay back taxes owed by the seller to be able to purchase the land, that could be considered part of the cost of the land. What else? Any closing costs could also be considered part of the cost of the land. All right, so let's keep going here. Hope you all are having a great day. Let's take a look at another problem here. All right, now Bent Willow Bakery purchased land, building, and equipment for a single purchase price of $600,000. So it's three different types of assets there. They purchased land, building, and equipment. Total price $600,000. However, the estimated fair values of the land, building, and equipment are $175,000, $455,000, and $70,000 respectively. So that's what $245,000 and $455,000, $700,000, I believe. But let's punch that in the old calculator just to make sure. I don't want to trust. Sometimes I can do math in my head, and sometimes I can't. So let's just make sure here. But $175,000 plus $455,000 plus $70,000. Yeah, $700,000. Those are the fair values of what we purchased, and they gave us that amount here. I didn't even have to do that. Should have read a little further before I punched it in. But anyway, it doesn't hurt to check that number is correct anyway. All right, determine the amounts for bent willow should record in the separate accounts for the land, the building, and the equipment. So you see what we're running into here. The fair values of the three assets total $700,000, but Bent Willow Bakery only paid $600,000 for it. So we can't allocate costs to the three asset groups above the purchase price, right? We want to record them at their cost. Well, what we're going to do is divide each one's fair value by the total fair value, get a percentage, and then multiply that percentage by the purchase price to get the amount to assign to each of the three categories. So let's look at our calculations here. For land, we would take 175, the fair value of the land, divided by 700,000, our total fair value, multiply it by the $600,000 purchase price, and we see that we want to debit the building equipment for $150,000. The building equipment, the building account for $150,000. Let me try that one more time. We're not debiting the building account for $150,000. We're debiting the land account for $150,000. Its fair value is $175 divided by $700,000 total fair value times the purchase price gives us a $150,000 cost for the land, not the building. We'll do the building next. The building's estimated fair value is $455 divided by total fair value, and then multiplied by the purchase price. That gives us a $390,000 cost for the building. And then the equipment estimated fair value is $70,000 divided by $700,000. Well, that's 10% of the $600,000, or $60,000 will be the cost assigned to the equipment. Now, stage 2, depreciation. Once the asset is acquired, it will be used in the operation of the company's business. So we must allocate the cost across all accounting periods in which it generates revenue. That's really our next section here. But you guys, referring back to this one, we would depreciate the building, we would depreciate the equipment, but we never depreciate land. It would go on the books at cost. Later, if it's sold, it would come off the books at its cost. All right, so we're going to look at calculating some depreciation next. In accounting, depreciation does not have anything to do with fair value. It's just the allocation of the asset's cost across the periods of its service life. Really, the purpose there, you guys, we want to take a portion of the cost of the asset as an expense each year that it's useful to the business in generating revenue. And that should make sense, right? Like, say, on this building, for instance, or let's go with the equipment. We wouldn't want to take the entire $60,000 as an expense in year one when we might use the equipment over a 5-year period, right? On the other end, we wouldn't want to take the entire $60,000 as an expense in year 5. So what we'll do is take a portion of the cost as an expense each year that equipment is used by the business to generate revenue. Okay, there are many methods of depreciation. In this class, we're going to focus on 3. The main one, you guys, is a straight line method. It's the most common method used by businesses in practice, and probably because it's the easiest to calculate. It's very straightforward. But it allocates an equal portion of the cost to each year of the asset's service life. An activity-based method, sometimes you'll hear this called maybe units of production method. Now that's a method that allocates depreciation based on the usage of the asset during the period. For example, we could depreciate a car based on the number of miles driven during the specific year. You can see it a lot with equipment. Might not show miles, but could show hours used instead. So hours could be another base besides mileage there. If you've ever been around a farm or driven a tractor or maybe driven a boat, a lot of times they'll show hours instead of miles. No tractors do anyway. The declining balance method, sometimes called double declining balance method. It's an accelerated method of depreciation, which means we're going to take more depreciation expense in the early years of the asset's life and then less in later years of the asset's life. It's not as common as the other two, but it's most appropriate for assets that have a big decline in value in the early years of their useful life, and repairs tend to go up with age. So to me, that description fits automobiles and maybe computer hardware pretty well. Big decline in value in the early years of their useful life, and repairs do tend to go up with age. Let's keep rolling here. All right, now, like I mentioned before, here's a pie chart that shows us which ones are most popular, and that's a little kind of small print there, at least for me, but it says 92% of assets depreciated by businesses would be depreciated using the straight line method. Only 3% for the activity-based method, and 4% for a declining balance or accelerated method. I had that backwards. I thought activity-based might be a little more popular than declining balance. Looks like I was off by 1%. And then there are some other methods, but they only make up about 1%. We'll only look at these three. All right, so let's see how to calculate depreciation using these three methods. To begin, there's some things that we must know in order to calculate depreciation. All right, well, you'll want to know the cost. We also need to know the asset's service life. We'll refer to that. I typically use the term useful life. That's how many years or periods we expect to use it in the business. And then the residual or salvage value is what we expect the asset to be worth at the end of its useful life. So service life and useful life are the same thing. So are residual value and salvage value. I tend to use useful life in discussing this. And I don't know, I sometimes go back and forth between residual value or salvage value. But anyway, they have those terms can be used interchangeably. All right, and then the method of depreciation that the company will use for that particular asset. You guys, a company does not have to use the same method company-wide, although it would be common for them to do so. They could pick maybe straight line method for buildings, activity-based method for equipment, and maybe declining balance or an accelerated method for automobiles or computer hardware. But a lot of businesses will pick one method and use it for all of their depreciable assets. All right, and finally, there are a couple of terms we must discuss before moving forward. I just used this one, depreciable cost. I believe I did anyway. The amount of the asset's cost that will be depreciated over the service life. You guys, it's always, the depreciable cost is always cost minus residual value. That's how much we will depreciate the asset. We can't depreciate it below its salvage or residual value. Book value, also called carrying value. Notice everything has two names. Not sure why exactly, but anyway, don't let that throw you off. Book value is always calculated as cost minus depreciation taken since the asset was placed in service. We call that accumulated depreciation. So we'll use these terms in our discussion of depreciation. All right, now here we've got problem 3. Let us eat salad bar acquired equipment on January 1, 2024 for $18,000. Okay, there's your cost. The company expects the residual value of $2,000 in a 5-year life. So there's your cost, the residual or salvage value, and useful life. Okay, the company's year end is December 31, so their fiscal year is the calendar year, and they want us to complete the following, assuming the company uses straight line depreciation. All right, what we're going to do first is calculate the annual amount. Anytime we're using straight line, it calculates the amount for the year. So we'll take the cost, $18,000, minus the residual value of $2,000, and then divide by the useful life in years. So it's 18,000 minus 2,000 is 16,000. Divided by 5 years gives us $3,200 of depreciation expense to take annually on this equipment purchased by the salad bar joint. All right, so now we're going to put these amounts in a chart. They give us the year, how much depreciation expense is taken in that year. Then accumulated depreciation would be how much depreciation has been taken since the asset was placed in service. And again, book value is cost minus accumulated depreciation. So for year 1 here will be 2024. Well, the depreciation for that year is our $3,200. Making our accumulated depreciation since the asset was placed in service, $3,200. Now our book value would be $18,000 minus the $3,200 of accumulated depreciation, gives us $14,800. Now you guys, this depreciation expense is going to be the same each of the 5 years. When we come down to 2025, we're going to take $3,200 in depreciation expense again in that year, but that's going to increase our accumulated depreciation up to $6,400. Its balance carries forward every year because it's a contra asset account reported on the balance sheet. Depreciation expense starts each year with a zero balance because it's a temporary account, an expense that's reported on the income statement. But now that's going to lower our book value by another $3,200, so we'd say $18,000 minus $6,400 to get $11,600 as the book value at the end of 2025. I think you can probably see where this is going by now. In 2026, depreciation expense is again going to be $3,200, bringing our accumulated depreciation up to $9,600. That's just $3,200 3 times. Now we'll say cost $18,000 minus $9,600 leaves us with a book value of $8,400 at the end of 2026. We'll depreciate the asset again in 2027 for $3,200, bringing accumulated depreciation up to $12,800 and the book value down to $5,200. And then in the final year, we'll take $3,200 of depreciation again, bringing accumulated depreciation up to $16,000. And you guys, our ending accumulated depreciation should be equal to our depreciable cost. Remember, depreciable cost is cost minus residual value, and our ending accumulated depreciation is $16,000, which is cost minus residual value. And then our ending book value should always be equal to the salvage or residual value. And note here that it is $2,000. Now, again, how did we get book value? Well, it's just cost minus accumulated depreciation. Then if the, there was only a 5-year useful life, right? But you guys, just because we've gotten to the end of the useful life, that doesn't mean we would discard the equipment. If the equipment is still working properly and we're still able to use it in the business, we'll continue to use it. We just won't depreciate it anymore. So in 2029, assuming this equipment is still in service, we would take no depreciation expense that year, but its accumulated depreciation, the accumulated depreciation associated with this equipment would stay on the books at 16 grand. The equipment would still be on the books at its cost of 18 grand. And the carrying amount or book value of the equipment would still be $2,000. And that would continue until the equipment is disposed of. So we could continue to use it beyond its useful life, but we will not continue to depreciate it beyond its useful life. All right, now to record the acquisition of the equipment, let's take a look here. We would debit the asset account equipment for $18,000 to increase its balance by the cost, and we'd credit cash for the same amount to decrease its balance. Now this is cash going out for an investing activity. Purchasing property, plant, and equipment is considered an investment. And what happened? We had an asset to increase by $18,000 and an asset to decrease by $18,000. So the net effect on assets would be 0. Now record depreciation for the first year, 2024. Well, we'll just debit depreciation expense for $3,200 from here and credit our contra asset account to increase its balance, accumulated depreciation. Remember, contra assets increase on the credit side. So what happened here? We had an expense to increase by $3,200, causing net income to decrease by $3,200, which in turn, through retained earnings, would cause stockholders' equity to decrease by $3,200. And the increase in the contra asset account would decrease assets by $3,200. Remember that contra asset accumulated depreciation would be subtracted from the cost of the asset on the face of the balance sheet, and the asset would be reported at its book value, which at the end of 2024 again was $14,800. No effect on cash flow there because neither of the accounts was cash. All right, now complete the same schedule, but assume the company purchased the asset on April 1, 2024. Well, then that means in 2024 we would only depreciate the asset for 9 months. What we can do here is say $18,000 minus the $2,000 residual value gets us to our depreciable cost of $16,000 divided by 5 years gets us to our $3,200. But we only are going to depreciate it for 9 months, April through December. We're not depreciating it January through March. So times 9 months divided by 12 months. So our depreciation expense for the first year, 2024, would only be $2,400 here instead of the full 32, because it wasn't placed in service at the beginning of the year. Instead, it was placed in service at the beginning of the second quarter. So here you'll note in 2024 we only depreciate the asset $2,400, making accumulated depreciation $2,400 and book value $18,000 minus $2,400 at $15,600. Now every other year, you guys, until the final year, we're going to take the full year's depreciation of $3,200, which each time increases accumulated depreciation and decreases book value. and that remains at $3,200 until we get to the final year, and then we'll only depreciate it for $800 for those 3 months that were missed in 2024 will be picked up in 2029. Now, how did we get to the 800? Well, it's just 32 minus the 24, or we could do it another way. We could say our 3,200 annual depreciation expense times it would only be used for 3 months in that last year, or only depreciated for 3 months in that last year. So times 3 divided by 12 gets us to our 800. And notice again, our total accumulated depreciation is equal to depreciable cost, and book value at the end is equal to residual or salvage value. Now, recorded depreciation for 2024. Well, it's only $2,400. Again, we would debit depreciation expense and credit accumulated depreciation. It causes our expenses to increase, which in turn causes net income and stockholders' equity to decrease. And then an increasing contra asset has the effect of decreasing assets. All right, let's cut this video off here, and we'll pick back up with problem 4 in our next video. Thanks.